why we switched to multifamily. There's a couple other really important reasons as well. So you have forced appreciation, which you're basically in control of the value of your asset. So when you drive NOI, net operating income, on a multifamily asset above 4 units, for us, it's typically above 100 units, you're driving the value up. So you're in control. Whereas a single family or a duplex or a triplex, you're really dependent on the comps that are around you. So how much is that other house selling for? That's likely what you're going to be able to get for that house. Whereas with multifamily, larger multifamily, you can really drive the value up, which is fantastic. And then tax advantages, massive benefit right now. Right now we have 80% bonus depreciation.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Will. And on today's show, we have with us Michael Roeder. Michael is the co-founder of Granite Towers Equity Group, a real estate private equity firm. Michael and his business partner, Dan, focus on acquiring and managing multifamily projects across the nation. He is also the co-host of the Keeping It Real Estate Show podcast and co-author of the book, 4 Steps to Successful Passive Investing. Michael, welcome to the show.
Thanks so much for having me on, Tim. I really appreciate it. Looking forward to it.
Yeah, and it's great to have you on. So I gave everyone a very high level overview of your background, but on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Certainly. So I started real estate investing back in 2009, second year in college. I was about 20 years old, and my girlfriend, which we had been dating for a few years, and I decided to purchase a 4-bedroom house. And we basically house hacked that house. We rented out 3 of the bedrooms to our buddies, and we stayed in the 4th bedroom. And that's really where we fell in love with real estate. At that time, it wasn't a significant amount of cash flow, but we were going to college. We were college students, and any additional cash flow was beneficial. So about a year and a half, 2 years later, we turned that into a full-blown rental, purchased a primary house elsewhere. And my original goal was to stack 100 single-family rentals over time. I didn't have a specific period of time that I wanted to do that in, but I knew I wanted to do it. I knew that real estate was the avenue that I wanted to take to become financially free and to build my passive income. Fast forward about 4 years later, we only had 3 single family rentals, and we were self-managing everything. They were all within about an hour to an hour and a half from our house. And so what had happened was I was commuting about an hour to downtown Minneapolis for my corporate job. Then I would get home, and then I would commute another hour up to a small town in Minnesota to do all the maintenance, to do the evictions, to lease to the tenants, basically to take care of everything so that way I could cash flow on those assets. And I started to get a little bit of burnout. And it was a tough thing because I knew real estate was the avenue, but it was basically creating another job for me, and I wasn't cash flowing a significant amount. So I took a step back, started to read every book I could, started to get educated, hired a mentor. And then also my business partner, Dan, had been buying apartment complexes, and it was working really well for him. He was putting in place third-party management. So they were taking care of all the day-to-day operations, which is what I was struggling with on single-family rentals. They were cash flowing. He was able to scale a little bit quicker. And so we decided to go into business together. We bought a 20 unit together, bought an 8 unit together. And then we formed our company about 7 years ago, Granite Towers Equity Group, and decided to start syndicating projects. So buying bigger projects with our money and with other limited partners' money. And that's really where we started to grow exponentially.
Yeah, that's awesome. And anyone who's listened to this show before knows that I love house hacking. I love the idea of it. And the reason I think it's so powerful is because you can get started with it at such a young age and relatively small amount of money. I'm not going to say it's nothing, right? If you're doing something like an FHA loan or a VA loan, where you're putting as little as 0 or 3.5% down on that mortgage, that could be huge just in terms of setting yourself up for the future. And some people do the the duplex or triplex route, which is a little more expensive. Obviously, you did the bedroom route, which works excellent if you're in college. I could attest. I've stayed in bedrooms before of other people's houses. So I think it's awesome. That's the way you got started. And it's like for the young people listening, and they wonder like, how is that even possible? I wasn't even thinking about this at the time. I was the one paying the rent to someone else who owned the property. And I wish I was thinking about it. But for the people, the young people who are thinking about this, that is a great entry point for real estate investing in general. I think it's such a great way to get started. But you did talk about some of the challenges once you started to try to scale up, right? You talked about 100 single family rentals. First, I'd like to hear you talk about why 100. What was the significance of that number?
Yeah, it was really the cash flow that 100 properties would kick off. I knew that would allow me to become financially free and some. And there wasn't a whole lot of thought that went into it, but I took a step back, looked at the numbers, and decided that was a long-term goal. And again, going back, I wish I would have at least put a time frame on that. I just said I wanted 100 single family rentals, but didn't really have a time frame. Didn't take a step back and say, hey, what action items do I need to do daily, weekly, monthly, yearly to hit this goal? So fast forward to today, whenever we set goals, we're taking a step back and figuring out what is it going to take to actually hit those goals.
Yeah, and I think that's probably the first step that a lot of people take when they start looking at bigger pockets, reading Rich Dad Poor Dad, etc. They want to find their freedom number, and for most
Mhm.
people, that means making enough passive cash flow to replace their current income. Just so we can set some kind of standardized definition. That's what I hear most people refer to it as, and that's what I thought of it as. I think the challenge is okay, 100 single family homes, right? It sounds simple on the surface of it, but a lot of people don't know until they start on that journey some of the challenges associated with getting 100 single family homes. And I'd like you to talk about that. Some of the ones that I'm thinking of off the top of my head are there's usually like a cap on the number of traditional mortgages that you can get. I believe it's 10, but I haven't looked at that in a while. And so just talk about that if you started to run into any of those challenges associated, especially with the single family market, and like why you decided to change direction.
Yeah, that's a great question. I really didn't run into any barriers like that because we only had three single family rental properties by the time I shifted over to multi. But like you said, the lending can be pretty tough. Also, with the lending, it's all recourse loans. So you're personally liable. So if you lose, let's say you do lose a house, they're going to come back against your personal assets. Where multifamily, we don't ever plan on having a multifamily project go bad, but it's non-recourse debts and they're not coming back against your personal assets. Also, the risk with single family is a lot higher. So if you think about a 100 unit apartment complex, and let's say you have an AC go out or you have to replace a roof, that CapEx project is spread amongst so many units. Whereas if you have a single family property and you have to replace an AC unit and it costs you $7,000, that might eat up your cash flow for 2, 3 years. And so the risk is fairly high. Same with vacancy. If you have a person move out of your single family residence, you're 100% vacant. Whereas if you have 10 people move out of your 100 unit property, you're still sitting at a 90% occupancy rate. We also love the economies of scale with multifamily. If you have a 100 unit property and maybe you have some other properties in the region, you can pull staff from other properties, which is very advantageous. You can get better negotiation power with vendors, contractors, property management firms. So we love that as well. We were excited to shift over to multifamily. The one mistake that we did when I look back is we went too small. We bought an 8 unit, a 20 unit, a 12 unit. And those projects, although I'm glad I bought them because it got me into the multifamily space, looking back at the performance, those were our weakest performers out of our entire portfolio. So I wish I would have tried to go a little bit larger as far as multifamily goes when we jumped into the space.
Yeah, and there's a couple of points I want to hit there because you talked about the non-recourse debt, and you did explain it, but I think we went over it pretty quick. So for people who are not familiar with that's a huge game changer just in terms of the level of risk that you're incurring. Like Michael said, when you have that single family property, it's all on you, your credit, etc. and the bank can come after you and your assets if you don't pay. When we talk about commercial multifamily, then you can get into non-recourse debt, which almost sounded too good to be true to me. Um, but the bank, their perspective is, hey, we'll just take the property back. And they don't want to hold properties, mind you. But at the same time, having that non-recourse debt is huge. And you're only going to get that over like what the $1 million threshold, something to that effect. And it may vary by banks, but I think that's a huge risk mitigate for people who are thinking about investing in multifamily more on the hands-on side of things. And you talked about also some of the economies of scale. And I think it's helpful just to give some perspective, right? So for people who are listening to the show and they have two or three single family rentals, they're likely paying around 10% was the average that I saw when I had single or even small multifamilies for a property manager, 10% of all rents.
Mhm.
But once you start scaling up, when you get to 100 units and above, that number is going to be closer to 3%. So that can make a huge difference in the long run, especially when, like you said, if you have an AC unit go out on a single family house or whatever, those things can wipe out an entire like month's worth of profits, or in some cases, a year's worth of net profits just in one instance. So at least you were saving that 10% because you were self managing. But talk about some of the challenges that came with self managing, because I know some of those challenges myself.
Oh, yeah. They were endless. I think the biggest thing was just missing time with my family because what would happen is I would get home from my corporate job at about 6 p.m. And then I would have that obligation to drive another hour and take care of the maintenance. And of course, you can hire someone to do the maintenance on single families. But again, it gets a little bit tough to cash flow when you're paying another individual to take care of all the issues. So that was an issue. Also, the tenants. I had a close relationship with the tenants. And when something went bad, like blew up in my face. I had a tenant that showed up on my doorstep and he ended up crying about a bankruptcy that he was going through and that emotional attachment to the tenant. It was very tough to navigate through. And that's really hard for that not to happen when you're the first person that they communicate with. So that was tough as well. But going back to the reasons why we switched to multifamily, there's a couple other really important reasons as well. So you have forced appreciation, which you're basically in control of the value of your asset. So when you drive NOI, net operating income on a multifamily asset above 4 units, for us, it's typically above 100 units, you're driving the value up. So you're in control. Whereas a single family or a duplex or a triplex, you're really dependent on the comps that are around you. So how much is that other house selling for? That's likely what you're going to be able to get for that house. Whereas with multifamily, larger multifamily, you can really drive the value up, which is fantastic. And then tax advantages, massive benefit right now. Right now, we have 80% bonus depreciation. If you do a cost segregation study, which is basically a study that breaks down all the pieces of the property and says, hey, you can depreciate the sidewalk this quick, the roofing this quick, the cabinetry this quick. It allows you to take a lot more depreciation in the first year of ownership, which can help offset your tax liability, whether it be through other investments or maybe your W 2 income. So that's a major benefit as well of multifamily. So those are just a couple other reasons why we made the switch.
Yeah, and some of those are huge, like you said, because people may have other investments, and this is a way to offset tax wise those other investments or even other real estate investments. I've seen, and it's not uncommon for the depreciation gained from an asset to completely wipe out the taxable income of the distributions from that asset. So that really helps a lot so that you're not raising your taxable income. It does get a little tricky when we talk about W 2 income. That's a little more nuanced. But I think the thing that you pointed out, forced appreciation, is a big deal because, again, folks who have that single family home, there's not a whole lot other than renovating it that they can do to raise the value, but there's still a cap to that. You could argue there's a cap on in commercial multifamily as well, but you can raise rents and you're not stuck to, like you said, the comps of those that are around you. It's not because commercial multifamily is just not valued the same way. And I think that's the first thing that people don't really understand is that people know how their house is valued. They don't understand how commercial multifamily is valued, which is based on how much money it brings in. And so, what I try to explain to folks is, hey, you have to value this like a business because that's exactly what it is. So, that's how I head into these conversations so that people understand the differences between the two.
Yeah, and just to share an example of forced appreciation, it's so powerful. If you increase, let's say you have a 100-unit property and you increase the income by $10,000 per month, which was not unheard of at all. That's $120,000 per year. If you divide that by what's called a cap rate, so that's essentially how multifamily is valued, you've increased the value by about $2.4 million. Small adjustments in the NOI on your income or reducing your expenses can make a massive change in the value of the property. So we absolutely love that. That's feasible with multifamily.
Yep, absolutely. So let's go into some of the things that you talked about. And I want to talk about the multifamily market right now. I would say for a while, yeah, I would consider it like the king of commercial real estate in the past couple of years. But some people would argue that it's starting to lose its luster a bit with things like interest rates going up and the amount of leverage that you can get on lending going down. Are you still all in on multifamily or are you considering other asset types?
Yeah, that's a great question. So we're still all in on multifamily, but it needs to be a fantastic location. We need to be paying close attention to the tenant base that are going to be renting from the property. We also need to make sure that we have the right leverage in place and that we have the right team in place. So those four aspects are crucially important right now. And you need to make sure that you're underwriting properly. Like you said, we're facing some headwinds right now. So insurance costs have skyrocketed across the nation. And I think they're up about a little bit over 20% across the nation over the last year. And some markets like Houston or West Palm Beach have been hit with 40 to 50% increases across the board. And you're seeing some operators with triple digit increases in their insurance. Property tax is also a big issue. So you need to know the location that you're getting into and how to properly underwrite the insurance and the taxes. But going back to the other factors, the type of tenant base that you're walking into, do your research on what the median household income is in the surrounding areas. And not only that, in the direct neighborhoods that you're going to be targeting, because that's crucially important. Obviously, with cost of living being driven up substantially by inflation over the last few years, you're seeing delinquency rise across the nation. And so you need to be very careful when you're getting into assets and make sure that you understand what kind of delinquency you're going to experience, what kind of vacancy you're going to experience, and then what are your expenses going to be like. So those are a few things that are really important to us. Now, your other question was, are we taking a look at other asset classes? We actually are. So we're taking a look at triple net lease properties right now, and we plan on purchasing at least a few of those per year to diversify our investors' portfolio. And we love that space as long as it's the right tenant and the right location. We focus on locations that are corporately backed or backed by at least 100 stores. So that way you have that financial security and you have a very good chance that that tenant is not going to go belly up. And then you want it in a great location. So that way, if something does happen to the tenant and you need to re-tenant that space, it's going to be relatively easy to do.
Yeah, I think triple net lease is an interesting segment that I've had a few guests on the show who specialize in that. The thing I always think about is just making sure that there's a really good anchor tenant. If
Mhm.
it's like a strip mall or something like that, I don't want some no name or something that I think is going to disappear, like a Macy's or I don't know. But talk to me about some of the advantages of triple net lease because it is a bit different from commercial family in terms of the length of those deals and I guess the risk involved. I would argue it's lower, but I'd be curious to hear your thoughts.
Yeah, that's a great question. So, a couple of benefits with triple net compared to a lot of other asset classes like office and multifamily. And number one, your tenants take care of the expenses. So they're on the hook for the property taxes, the insurance, the maintenance, if it's a true triple net lease property.
Mhm.
And with inflation and expenses increasing so rapidly over the last few years, that's created an issue for a lot of owners of retail spaces or office or multifamily if they didn't underwrite properly. So you're taking that risk off the table. Like you said, there's also longer lease periods, which is a double edged sword. So, first off, you're doing less over a 5, 10, 15-year period because you have that single tenant in there. But if you don't have rent increases built into that long term lease, that may negatively affect you. Whereas multifamily, the thing we love about that is if rents are increasing, we have a 12-month lease or maybe a 6-month lease, we can increase rents very quickly. So, again, you need to make sure you know what you're getting into, feel comfortable with the rent increases that are built into the lease. But we really like that as well.
Yeah, that makes a lot of sense. And I think most of the leases that I've heard about do have some kind of increase, but your point still stands that what if the market is moving faster than
Mhm.
those increases that you have built into your contract, then you're leaving money on the table. And there's not a whole lot you can do about it at that point, I would imagine. No, that's interesting because there's so many different asset types out there. And I think people don't realize that. It gets really annoying to me when I hear the term CRE or just commercial real estate thrown around as if it is like one giant thing. And I was like, you have any idea how diverse that is of a grouping? That encompasses everything when you just say it like that. That includes triple net leases, retail, that includes commercial multifamily, that includes warehouse, industrial, like the list goes on and on. So to talk about trends associated with CRE, I think is just absolutely ridiculous unless you drill down on what exactly it is you're talking about.
100%. And each of those asset classes within commercial real estate are so drastically different. You take office, for example, you might have a 40 to 50% vacancy rate right now. Whereas you jump into multifamily in a hot market like Dallas, Fort Worth, and your vacancy rate might be 5 or 6%. So drastic differences in between the two or in between all the asset classes in commercial real estate. And I also wanted to point out one other benefit of triple net lease spaces as well, just consistent cash flow. When you
Mhm.
step in day one, you have that tenant in place. And so you're consistently getting the cash flow, likely whatever you underwrote into your plan as long as everything goes as planned each quarter or each month. And we love that about triple net lease as well.
Yeah, and there's diversification not even just within the different asset types, but also within the respective assets themselves. You talked about having to know the tenant base and what that looks like, which makes me think about A class, B class, C class within commercial multifamily and how different investors play in those different classes. What class of property are you usually investing in and why?
Yeah, that's a great question. So we stick to B and C class multifamily apartment complexes. We do have one A class, and that was a diamond in the rough that we found. But we found it to be very tough to find A class properties that make sense with our business plan. So typically, we want to step in and we want to drive up the value by renovating units, renovating the exterior, driving the income up, and then possibly driving down the expenses. Whereas A class, a lot of times everything has been done. So it's been tough for us to get into that asset class. The other thing I love about B and C class properties is you typically have the trickle down effect when an economy goes downwards. So like an economy that we're in right now, a lot of times the A class tenants, if they can't afford it, they're moving to the B class or moving to the C. And so it's a little bit more insulated when it comes to vacancy rates and delinquency as you go into an economic downturn. So we love that as well. I would say the bulk of our properties, probably about 50-50 in C class, 50% in A class, or sorry, B class.
Yeah, and I think that's a really great point that a lot of people don't talk about. We say that multifamily is recession resistant, but a lot of people don't talk about why. And
Mhm.
one of the main reasons why is exactly the reason you just mentioned, which is I'm not going to say everybody needs a place to live. That's too generic. But if they're already renters, and like you said, if they're in that A class and it becomes too expensive, they can always bump down to that B class and then same down to C class. You usually don't go down from there because Nobody wants to go to D class. But I think that's an important point. It insulates you a bit from the risk of a recession. And that's what we play in as well. I think we're at a point where we'd like to get away from C class. It's one of the only areas where we're still able to make the numbers work. Like you talked about with it's virtually impossible to get the returns that investors would want because you're not able to add the amount of value that's required for those returns. But you can still make that happen in a B class, in a C class. But with a C class, you have more tenant issues than you would at a B class in terms of whether it's delinquencies or eviction, et cetera. And so those are not only headaches that you have to deal with, but they also have a real cost in terms of dollars in turning those tenants and getting new tenants in there. So it becomes this kind of, do I want to deal with it? But at the same time, so I don't know what your thoughts are there, but that's what we've run into.
Yeah, and that's really interesting, Tim, that you say that you're possibly getting out of the C class arena in the future, that you'd like to do that. We actually, about a year and a half ago, we were considering, or we put in place, we said, we're not going to buy anything that was built before 1985. So we were really focusing on B class and then possibly A if the right property came down the pipeline. And we ended up taking a step back about a quarter after we put that into place. And we looked at our portfolio and we're like, gosh, some of our best performers were built in the 60s and 70s. So as long as we underwrite properly and we're getting into the right area, we're comfortable with C class. So we actually opened it back up and we bought multiple C class properties that have done really well since then. But to your point, you're dealing with a little bit tougher demographic. You have to deal with the turn costs. You have to deal with maybe higher delinquency rate. So you just need to know what you're getting into and make sure to underwrite for it properly.
Yeah, I think the bottom line is it's just more management intensive. So
Hmm.
if you're that asset manager, you need to make sure that you are picking the right property manager for that asset type. Not all property managers are created equal. I'm sure you know this. And some just have specialties, right? Some are better able to ensure that capex, the construction is going well on the property, and that's something they have experience at. Some are much more used to managing C class properties and they understand and can manage that tenant base. So you have to make sure that you have the not only a good property manager, but the right fit for the property type that you're looking to fill.
100%. And not only your property management firm, but also your regional, your on-site manager, your maintenance tech, your leasing staff. Everyone, every piece of the puzzle is crucial when it comes to your payroll that you're paying out. And if you see that there's not synergy, or maybe someone isn't cutting the slack and they're not doing their job properly, you need to make sure that they get trained in properly or that they get let go and you bring someone on that's an A player. And that's something that we've adjusted over the last 12 to 18 months is we're increasing the amount of funds that we have for payroll in our expense budget. So that way we can really focus on hiring A players, because I can't tell you how much of a difference it makes when you have an A player compared to a B player at a property. It helps you drive the income up so much quicker. You have less issues, better synergy at the property, just endless benefits. So that is crucial in multifamily and probably every other commercial real estate avenue that you take.
Yeah, absolutely. So caveating off that, let's talk about asset management. And I'm curious because you have a portfolio right now. It's about 2,500 units, which is a lot. And so I'm curious if you are asset managing all those properties that you have in your portfolio. And just to clarify for the listeners what asset management means, basically it's the role of the asset managers are general partners on the deal who manage the property manager. And they also manage the construction if you have that going on at the property and make sure that the business plan is instituted and that everything stays on time and budget. So, with that being said, I'll go ahead and let you answer the question.
Yeah, great question. So we do asset managing everything in-house at Granite Towers Equity Group. Now, we do have a full-time asset manager located in Fort Worth, and she oversees our Texas portfolio. However, Dan and myself, were the owners of the company, we're very in tune and involved in the asset management as well. But with 2,500 units, it would be very tough to do that alone by ourselves. So we have a team surrounding ourselves. Again, we have Dawn down in Dallas Fort Worth, who's a full time asset manager. So she'll visit all the properties typically on a weekly basis, checking in on the CapEx projects, maybe bringing a gift or something to say thank you to the on site employees, checking in on the grounds, just making sure that there's team synergy. And then typically Dan and I will fly into the markets about once a month to tour the assets as well and get a second set of eyes on the property. We also have some other staff members that work for us full time that do secret shops on our properties to make sure that the leasing staff is doing a great job. They take a look at all of our marketing online because sometimes when you go out and you visit the property website or apartments.com or Zillow, sometimes the phone number might be off or the rents might be off or the concessions aren't showing properly. There's so many little pieces to asset management that are crucial. As you grow, I would highly recommend once you hit 4 or 5 properties that you consider leveraging someone else's time, unless you have a bunch of general partners that are very in tune with asset management, because otherwise it's going to get out of hand pretty quickly. And that's something that we pride ourselves on. I think we do a very good job at asset management. It's what we're known for in the industry. And we actually have a asset management course that we've been building out over the last 6 months that we're going to launch here in a couple of months. We're excited about that as well.
Yeah, and you already answered another one of my questions that I was going to follow up with, which is what is that point at which it makes sense to go ahead and hire an asset manager? And it sounds like you said 4 to 5 properties. Now, does that mean within that geographic region, or are you just talking?
That's a tough question. So generally 4 to 5 properties, but if Tim, let's say you and I went into business together and this was our sole business, we didn't have a corporate job, we were sticking 40 to 60 hours a week into multifamily real estate, you could probably get by with maybe 7, 8, 9 properties before you bring out a full-time asset manager. But if you have another job and you don't have a significant amount of time, you're going to need it sooner than later. And back to your question, I would say 4 or 5 properties across the board, regardless of what state they're in. But looking back on our multifamily venture and what we've done over the last 8, 9 years, the one thing that I wish I would have done differently is focus on a smaller geographic region. We were very opportunistic when we got into the industry and we bought a property in Minnesota, one in Wisconsin, one in Alabama, one in New Mexico. And then we jumped into DFW and really focused on that market. And it was okay when we started off, but you need to know those markets. You need to know what's going on, know what the trends are, know what the supply is like. And then plus you have to get eyes on the property. So flying all over the country to these different markets makes it really tough on you, your family, your business partners. So again, I would highly recommend trying to focus on one region if you could.
Yeah, it's just like when you're starting out as a general partner, it's hard to temper the eagerness, especially when you find deals that work. You're like, I don't care where it is. It's over here. Okay, great. I'll partner with this guy. He seems good. And then you learn lessons along the way, like maybe I should have been a little more selective with who I partnered with. And maybe I should have concentrated in a region more. Like you said, I think those are all valuable lessons as you go along. And then you pivot to where it makes sense, which is, it sounds like that's exactly what you did. No, that's awesome. I appreciate the insight on asset management because I it's just interesting to see how other operators do it. And for the listeners, the reason why it becomes onerous at a point is because if you are asset managing, then your calendar starts to fill up rather quickly because you have all these property management meetings that you need to be on in order to get the updates from the property managers and provide guidance. That's once a week for all your properties and you have 5 properties, okay, that's at least 5 meetings. Then you probably have a meeting with your general partners that's going to be at least, I don't know, say once a month at a minimum. At the beginning, though, it might be once a week or every couple of weeks. So all these meeting times just start to pile up and it can be a lot the higher you go.
It really can. I think about our portfolio. We have 19 active properties right now. And each meeting is maybe a half an hour to an hour. So you might spend 19 hours on the phone with these property managers. Plus, you have to review the financials. You're obviously dealing with a lot of lender requests, a lot of other requests from the property management team. You're doing investor updates. So it does fill your calendar very quickly, like you said, Tim.
Yep. And so going into the number of units you had, we talked about it as like about 2,500. And that is a lot. And that for the listeners, that number does fluctuate because you may exit a property or sell it, in other words. And so then it may go down and then you buy another property and then it goes back up again. But still, 2,500 is a lot. And I'm curious as to how you were able to scale to such a large portfolio in what is a relatively short amount of time.
Yeah. So the way we scaled, we started out small and we worked our way up. So going back to 2017, we had bought a 20 unit together, myself and Dan, an 8 unit together. And then I had a few single family properties. Dan had also bought a few apartment complexes before then. But when we started our company, our first property was a 45 unit property in Western Wisconsin in a smaller town. We raised $575,000 for that project, bought it for about 2 million. And so that was our first project. We ended up selling it about 3 years later for twice the value. So it was a nice little home run. But we started out with that. Then we went to an 86 unit. Then we went to a 101 unit. And we eventually worked our way up. And now we're really focusing on anywhere in between 150 to 400 units is our sweet spot. But we did it over time. We were constantly networking with individuals. We were focusing on our systems and our operations. That's something that I specialize in. I love it. It's part of who I am. And so every day I'm just trying to think of how can we be more efficient, because that equates into driving the value of your properties up if you and your team can be more efficient. So that's helped us out substantially. And then investor referrals, when it comes to raising capital right now, it's a tough time because there's a lot of fear in the market. And that's with stocks and bonds, it's with commercial real estate, it's with whatever investment class that you're looking at. And so the better that you can do for your investors along your real estate career, the more referrals will pour in. And so that's helped us out substantially over the years, is just continuing to do exactly what we said we were going to do, perform well on your properties, and you'll be able to grow exponentially as you go.
Yeah, that's awesome. I appreciate those insights. Hey, Michael, we do have to transition to the turbo round. So I am going to ask you three questions that I ask every guest that I have on the show. And I just ask that you give me a quick, honest answer. The first question: what is one red flag every investor should look out for?
Yeah. So one red flag, I would say over promising returns. So if you see an investment out there, and this is with multifamily or any other asset class, and they're promising maybe a 200% over a 5 year period, 30, 40% annually, that would be a major red flag for me. Just because it's very tough to hit those metrics. Right now in multifamily, we're seeing anywhere from 70 to maybe a 95% return over 5 years, and that's still tough to find. So if you're seeing an astronomical return, just beware.
Yeah, no, that totally makes sense. We did see some pretty astronomical returns during the COVID, but that period has since passed. Investors need to temper their expectations. And like you said, if it sounds too good to be true, it probably is. All right. What is a myth about this business that you would like to set straight?
Yeah, I think the biggest myth is that it's hands off, that you can jump in, buy a multifamily property, hire a third party property management company, and you can step away and you can have this great cash flow coming in, great passive income, and be financially free eventually. That's not the case. If you're a general partner, there is a lot of blood, sweat, and tears that goes into the asset management. And we've seen time and time again where an operator will jump in, they'll buy a multifamily property, they'll step away because they fully trust the third-party property management team, and that property quickly slips and falls apart. We actually just saw a few properties down in Texas that went back to the bank because that exact thing happened. The gentleman just was not involved in the asset management, and you have to be overseeing the property management companies.
Yeah, and I've seen it as well. I don't want to call it shiny objects, but like some of them get to closing, and once they think things are rolling, then they're like, okay, now we're looking at this other property we need to buy. And then they focus all their attention on that new property that they're looking to acquire and let things slide with the other ones. And it's super frustrating if you're one of their partners on the deal. So don't be that guy or girl. That's all I'll say. All right. Final question. What does success look like to you?
Yeah, success to me is being financially free and being able to work with my time. So spend my time where I'd like to. So having time for my kids, being able to go to the sporting events, having time to go on a weekly date night with my wife, and still being able to perform on the business side and hit the projected returns for our investors and create a great life for them with our investments. So that's success in my eyes.
Yeah, that's awesome. I couldn't agree more. All right, Michael. Hey, this has been awesome. Please tell our guests how they can get a hold of you and if there's anything else that you'd like to share with them.
Thanks so much, Tim, for having me on. So you can get a hold of me by jumping onto our website. It's called the Granite Towers Equity Group.com. Fill out the contact us page if you'd like to stay in touch with what we're doing. And then we also have our free ebook on there. And if you do fill out that contact us form, put in free passive investment tracker, and we'll send you over our free passive investment tracker as well.
All right, there you go. Free passive investment tracker. Michael, again, thanks. And we'll have all that information in the show notes so people can go ahead and get that stuff. But I appreciate you coming on, and I look forward to continuing to see you do big things on your journey to multifamily millions.
Thanks so much, Tim, for having me on.
Thank you.